You won't believe what just impacted the silver and copper markets. The president initiated a 180-day timeline that could establish a new minimum pricing framework for strategic minerals. Yes, that includes silver and copper, using trade discussions initially, followed by firm measures. If negotiations collapse, authorities have a straightforward route to intervene and restructure the pricing you're witnessing. That's what occurred. That's the development. And shortly, you'll understand why this extends beyond headlines, why initial price movements might be minimal compared to what's coming, and why the genuine disruption could arrive on day 179 when most assume the timeline continues. Here's why staying until the end matters. Early coverage will emphasize tariffs that haven't materialized, while the actual instrument is the minimum pricing framework concealed in plain view. I'll explain how this framework can compel buyers to secure supply preemptively, why even successful negotiations can elevate prices, and the key indicator revealing strategic accumulation by sophisticated investors. Miss that indicator and you'll arrive after the movement paying elevated premiums. Before going deeper, a quick request. I'm combating duplicate channels that steal original content and republish it. To support authentic work, please subscribe and comment below to show engagement. Additionally, for daily briefings, rapid updates, personal perspectives, instant voice messages, and timely alerts not posted on video platforms, I've established a communication channel. Link appears in the description. Join because when markets shift, velocity matters more than speculation. What this declaration actually means. Let's discuss what this proclamation genuinely signifies without embellishment. The consequences could become substantial. This plan doesn't target a single material, it addresses a collection. Substances powering batteries, electrical grids, defense systems, electronics, and the upcoming industrial competition wave. Lithium, nickel, cobalt, rare elements, plus 2 commodities that trigger market reactions like alarm bells, silver and copper. Here's the unexpected element. The initial action isn't tariffs. The opening move involves negotiated price minimums with partner nations. Essentially, a coordinated minimum import threshold designed to prevent what officials term predatory pricing while stabilizing supply chains. It appears diplomatic, it sounds administrative, it resembles bureaucracy. But price minimums aren't bureaucratic paperwork. Price minimums represent authority. A price minimum is the demand-side equivalent of a tariff. Tariffs impose additional costs. Price minimums declare this commodity cannot enter below a specified threshold. Period. When enforced comprehensively, you're not merely altering trade, you're transforming the entire incentive framework for producers, processors, and purchasers. The timeline strategy, observe carefully. No tariffs exist currently, that's significant. No immediate, we're imposing 25% across the board. Instead, they initiated the countdown, 180 days. Negotiate, coordinate, align. Subsequently, if unsuccessful, minimum import thresholds and national security-style limitations remain available for deployment. National security measures aren't minor instruments. They're substantial levers capable of shifting entire industries. That's why markets don't wait for day 180. Markets begin positioning for outcomes immediately. Some wonder why that specific time frame? It's sufficient to appear reasonable, yet brief enough to generate urgency. It accommodates procurement cycles, political cycles, negotiation rhythms. Most importantly, it suits market cycles. 6 months provides perfect opportunity for institutions to reposition without acknowledging their repositioning. Here's what this means for you. Month 1, headlines and uncertainty. Months 2 to 3, progress narratives, information leaks, sudden optimism encouraging complacency. Months 4-5, pressure, deadlines, warnings, final proposals, when genuine buying often begins discreetly because major participants avoid appearing desperate. Month 6, the public awakens asking, what happens now? By which time strategic capital has already positioned. If you're treating this as a single-day news cycle, you're already behind. Understanding price minimums. Let me clarify price minimums accessibly. If authorities declare, we won't permit imported processed silver or copper products below a specified threshold, the cheapest supply vanishes immediately. Not because material disappeared, but because regulations changed. When cheapest supply disappears, everyone competes for next cheapest alternatives. That's how minimums can elevate the entire pricing curve without additional buyers. But minimums require enforcement mechanisms, reference pricing, documentation, audits, penalties for misreporting, anti-circumvention provisions preventing companies from relabeling products and bypassing through alternative categories. That's why a minimum isn't merely a number, it's a complete system, and systems create advantage positions. If you're aligned, transparent, and already within preferred supply networks, the system provides momentum. If you're excluded, the system becomes a barrier. The narrative battle. Watch how the framing conflict unfolds because this is where emotional manipulation occurs. One perspective claims this is protectionism, market interference. The opposing view argues this is national security, resilience building. Both can simultaneously be accurate. While they debate, those consistently winning are individuals who position early and manage exposure effectively. That's why I emphasize this repeatedly. The objective isn't being correct, it's being prepared. Section 232 implications. Let's address national security provisions briefly because people hear this and dismiss it. These legal pathways treat commerce as security concerns. When something becomes a security matter, it gains political priority. This can mean quotas, tariffs, limitations on specific product categories, exceptions for allies, and restrictions on others. And implementation can occur rapidly, particularly if negotiations become publicly embarrassing. The countdown is also a credibility assessment. If leadership declares, "We'll address this dependency," then does nothing, it appears weak. If leadership declares, "We'll address this dependency," and follows through, it demonstrates strength. Consider which option politics typically selects when scrutiny intensifies. The unexpected outcome. Here's a development most won't anticipate. Even if negotiations succeed, you can still experience elevated prices, because successful negotiations can still incorporate minimum acceptable pricing frameworks, commitments to prevent dumping, coordinated stockpiling, and voluntary limitations functioning like restrictions. Don't assume agreements equal inexpensive materials. Agreements can be mechanisms legitimizing minimums. 3 scenarios. Let me outline 3 scenarios quickly. Tell me in comments which seems most probable. Scenario 1, smooth coordination. Allies cooperate. Minimum pricing quietly accepted. Supply continues flowing at higher, stabilized levels. Volatility diminishes. Everyone pretends it was always predictable. The responsible adult's outcome. Scenario 2, messy compromise discussions drag. Headlines fluctuate daily. Markets swing violently. Last minute, a patchwork agreement emerges, full of exceptions, loopholes, conditions. Pricing whipsaws because nobody trusts details. The "we avoided catastrophe perhaps" outcome. Scenario 3. Collapse negotiations fail. Minimum import thresholds and restrictions implemented. Retaliation warnings surface. Buyers scramble securing supply. Miners and processors become strategic assets. Markets reprice the entire sector rapidly. The shock and disruption outcome. Here's the concerning part. Even anticipating Scenario 1, markets can trade Scenario 3 for extended periods simply because the possibility exists. Risk management matters. What to monitor? During 180 days. Watch for announcements regarding joint reserves, language about secure processing and trusted supply chains, new funding initiatives, loan guarantees, expedited permits, strategic alliances, procurement modifications in defense and infrastructure projects, sudden export regulation changes from other nations. And watch the subtle signal. Long-term supply agreements, because those agreements reflect where future pricing gets established. Reading market action. Let's connect this to market movements again because this maintains clarity. Violent sell-offs following constructive news often indicate 2 possibilities. Either markets were overcrowded requiring participant shakeouts, or markets are detecting something else, side agreements, carve-outs, or macro risks before headline confirmation. Don't speculate, observe. If silver and copper stabilize after initial shock, that's information. If they continue cascading without rebounds, that's information. If they rebound but volume diminishes, that's information. If they rebound with sustained participation, that's information. Markets communicate in brief bursts. Mining company considerations. Here's something saving you difficulty. Don't treat mining companies like lottery tickets. If engaging with miners, approach it as business analysis. Examine reserves, jurisdiction, permits, balance sheets, and capacity to finance without shareholder destruction. When policy capital appears, superior companies strengthen while inferior companies become louder. Loudness doesn't generate returns. Execution generates returns. If you want future content breaking down mining due diligence checklists without promoting specific names, just teaching evaluation criteria, indicate interest in comments so I understand what to create next. Engagement questions. One more question, because I'm genuinely interested. Do you believe government-established price minimums signal strength or indicate the free market era is concluding? Share your perspective because this transcends trading narratives. It's a philosophical transformation. What traders did. Traders did what they always do when genuine structural developments hit highly emotional markets. They overreacted, then they fought about it. You witnessed volatility, rapid selling, sharp recoveries, people calling tops, calling bottoms, then calling each other foolish, sometimes within the same hour. Silver dropped sharply, then got purchased, then slipped again. Copper got hit. Energy moved. Yields wobbled. Equities acted independently like usual, pretending metals are unrelated problems until they aren't. If wondering why selling can be aggressive even on constructive news, it's straightforward. Positioning. When too many participants already lean one direction, constructive news becomes justification for short-term profit-taking, liquidation, and forced rebalancing. The narrative can be constructive while the tape appears ugly, but don't fixate on the initial candle. The initial candle rarely conveys the genuine message. The authentic message emerges after markets have time processing. The control question. Because this 180-day countdown isn't merely about pricing, it's about control. Here's what many miss. If government establishes or enforces price minimums, it's effectively determining the minimum revenue foreign supply must receive for domestic market entry. That can redirect flows, attract supply, starve competitors, and accelerate production decisions normally requiring years. Then there's the part nobody openly discusses. If you can establish minimum pricing, you can also justify stockpiling, subsidizing domestic refining, building capacity, and intervening in markets temporarily until stability returns. Temporary programs have curious habits of becoming permanent institutions. Is this constructive? So if asking, is this constructive for silver and copper? The answer is, it can be constructive in ways not immediately appearing constructive, because initially you can experience chaos, negotiations, diplomatic headlines sounding like relief that end up being traps. Let me illustrate the trap. Imagine an agreement. We'll provide access to X if you provide access to Y. Markets love that. Markets hear agreement and purchase risk, sell fear, relax. But if agreements involve exchanging strategic resources, rare elements for energy, metals for technology, supply for security, then agreements can also limit upside in some areas while exploding it in others. That's why I emphasize, don't just watch prices. Watch the structure being constructed behind pricing. Because once structure exists, it changes how every decline and rally behaves. Clear positioning. Let me pause briefly and clarify something. I'm not suggesting panic purchasing. I'm not proclaiming astronomical projections. I'm mapping the strategic landscape, and the landscape is transforming. If government seriously pursues reshoring strategic supply chains, two unavoidable outcomes exist. Outcome 1, higher guaranteed pricing in some chain segments because you need producers to invest. Outcome 2, capital flows toward companies actually capable of delivering genuine supply. Not the loudest tickers, not superior marketing, but operations possessing reserves, permits, and production pathways. That's where opportunity and danger coexist simultaneously. Because people hear silver and think exclusively about coins and bars, but governments hear silver and copper and think wiring, defense, electronics, grid modernization, and industrial capacity. Different purchasers, different time frames, different tolerance thresholds. What to do? If watching from home thinking, okay, so what should I do with this information? Stay with me, because shortly we'll discuss what this could mean for physical metal versus mining companies and why some of the largest gains may not be in metal itself, but in the infrastructure supporting it. What government is actually preventing? What is government genuinely trying to prevent, being held hostage by limited foreign bottlenecks? Processed strategic minerals are the constraint. It's not merely, do we have material underground? It's, can we refine it, process it, convert it into forms industry actually requires, and do it reliably? When a proclamation labels that dependency a national security threat, you've entered a new category. This is no longer trade policy, this is strategic policy. And strategic policy doesn't request market permission. It informs markets what the new framework is. Price floors explained. This is where price minimums become significant. A negotiated minimum with allies accomplishes two objectives simultaneously. It blocks ultra-inexpensive supply undercutting domestic investment. And it gives producers confidence that expansion won't be destroyed by sudden price dumping. That's the presentation, that's the framing. But practically, it means the state is influencing pricing. And when states influence pricing, one question becomes unavoidable. Who gets preferential treatment? Because not every producer benefits under minimums. Winners are compliant, allied, and strategically valuable participants. Losers can still sell, just not here, or not at that price, or not without constraints. So even before day 180, companies and countries begin repositioning. Some rush signing, some delay, some threaten retaliation, some offer side arrangements, some attempt breaking coalitions. And amid that chaos, markets attempt predicting one thing. Will negotiations fail? Because failure triggers heavy instruments. Minimum import pricing, national security restrictions, and potentially broader actions. Nobody wants spelling out in press releases. That's why this is a countdown narrative. Not one decision, but a sequence. And sequences are where tension builds. The real deadline. Let me provide the first key point right now. The 180 days may not be the genuine deadline. The authentic deadline is when large purchasers decide they cannot risk waiting. When manufacturers begin whispering, we should secure supply now. When procurement teams decide it's less expensive locking in today than gambling on policy tomorrow, that's when stockpiling begins. Not by governments, but by private sector attempting to anticipate government action. And that's when pricing can move in ways charts cannot explain. Market action analysis. Let's address the market action you witnessed because it wasn't random. Silver experienced violent downward movement, then rapid buying. That typically indicates two groups fighting. Group 1 is leveraged. They get forced out when volatility strikes. Group 2 has conviction. They step in when pricing reaches levels they consider unjustified. Here's what makes this moment unique. If price minimums are approaching, unjustified levels become easier defining because policy creates an implied backstop. Even if the minimum isn't official yet, markets begin pricing the possibility. That's why you can witness a falling knife get caught even while headlines are still being processed. But exercise caution. A caught knife can still injure because the session isn't finished until it's finished. And in markets, the second wave often proves worse than the first. What to watch? What should you monitor? Watch how pricing behaves around key levels after the initial rebound. If pricing breaks below support, continues falling, and closes weak, then structure is dominating and you could witness another leg down. But if pricing dips, recovers sharply, and holds, then you're witnessing accumulation under stress. And accumulation under stress is how significant movements begin. I understand some love pure technical analysis and some dislike it. So I'll keep it straightforward. The chart isn't the narrative. The chart is the scoreboard. Policy is the game. And the game just transformed. Miners versus metal. Earlier I mentioned opportunity may be less in metals themselves and more in mining companies. Let's explore that without exaggeration. If government wants secure supply, it requires production. If it requires production, it requires investment. If it requires investment, it requires profitability. If it requires profitability, it requires pricing. That's the chain. So a price minimum, even as a negotiated concept, is essentially declaring, we might guarantee your economics. And that can revalue companies previously ignored because capital was too expensive or projects were too premature or markets didn't care. And this is enormous, most mining companies aren't built identically. Some possess real reserves, some possess aspirations, some possess permits, some possess presentations. Some possess management capable of execution, some possess management only capable of fundraising. So the opportunity isn't miners rise universally. The opportunity is appropriate miners receive additional momentum. And that momentum isn't merely metal pricing, it's policy support, funding access, strategic partnerships, political incentives ensuring certain projects survive. If you capture a company receiving the metal movement plus the policy movement, you can experience multiplier effects. But if you capture the wrong one, you experience dilution, delays, and disappointment. If you want additional content on evaluating miners, indicate below, because I can explore deeply what to seek, without naming specific companies, without promotion, just teaching filtration methods. Two questions for you. Answer honestly in comments. Do you believe the 180-day negotiations conclude with calm agreements, or do you believe they conclude with restrictions and disruption? Second, if silver and copper become strategic, do you believe average investors are early or already late? Share your perspectives below. I read more than you realize. Macro context. Let's address the broader economic backdrop, making this proclamation feel like accelerant on dry kindling. We're in an environment where every major economy desires identical outcomes, growth without difficulty. The easiest method governments attempt buying time is weakening currency and subsidizing industry. That's not conspiracy, that's policy. And when multiple countries do this simultaneously, you experience competition not just in commerce, but in industrial capacity. That's why strategic minerals are a battleground currently, not because metals are attractive, but because metals are leverage. Control inputs, control outputs. Control outputs, control economic engines. Control economic engines, control negotiating power. So a proclamation on imports is actually a strategic maneuver in a broader resource competition. Next development. Here's another key point. If price minimums get discussed for strategic minerals today, what gets discussed next? Because once government normalizes intervening in one strategic market, intervening in another becomes easier. And markets dislike uncertainty until learning how profiting from it. So first movers get rewarded and late movers get punished. That's why I emphasize paying attention to structure. Market complexity. I also want to address something potentially confusing. You might witness energy falling on days when expecting geopolitical concerns to push higher. You might witness equities rallying when expecting policy risk to push lower. You might witness gold softening while silver whipsaws. That doesn't mean the narrative is false. It means markets are messy machines of positioning, liquidity, and cross-asset flows. Sometimes the clearest headlines get drowned by the loudest forced trades. Don't let one day's tape trick you into abandoning the larger framework, because the larger framework is government signaling they won't tolerate supply dependency. And once that signal releases, it doesn't return to containment. Physical versus miners, I promised discussing physical metal versus miners. Here's the honest answer. Physical metal is about ownership, removing counterparty risk, possessing an asset independent of CEOs, boards, permits, or quarterly reports. Miners are about leverage. They can move more than metal, but can also fall more than metal. Which is superior? Depends on your objective. If your goal is safety, lean physical. If your goal is upside, research miners. If your goal is balance, you can divide. But whatever you do, don't confuse the two, because when policy shifts, physical can become scarce while miners become politically valuable. And politically valuable is a peculiar type of constructive. It can mean support, but also scrutiny. Subsidies, but also regulations. So the approach isn't buy and forget. The approach is buy and stay alert. The timer is weapon. Let me return to the 180-day timer again, because the timer is the psychological instrument. It tells everyone in supply chains, decide. It tells allies, get aligned. It tells producers, prepare. It tells purchasers, secure. And it tells speculators, anticipate. That's why you'll witness colliding narratives. One day you'll hear, the minimum is approaching, purchase the decline. Another day you'll hear, discussions progress well, crisis avoided. Then you'll hear, talk stalled, restrictions probable. Then you'll hear, a surprise agreement is imminent. And throughout all of it, pricing will swing to punish delayed decisions. Staying grounded. Here's a straightforward method, staying grounded. Ask yourself 3 questions weekly during the countdown. What did policy do? What did major purchasers do? What did pricing do after initial reaction? If you can answer those 3, you'll be ahead of most people only reacting to headlines. Additional resources. Quick reminder, premium content should already be available where I consolidate latest developments in one place and explore more thoroughly than possible here. If you want that enhanced analysis, join the membership. It also demonstrates who's genuinely following and supporting the work when it matters. In membership, I'll be sharing deeper analysis as this countdown evolves. Coordination layer. Back to core narrative, because there's another dimension. Negotiating price minimums with allies implies coordination. Coordination implies shared enforcement. Shared enforcement implies shared intelligence. And shared intelligence implies countries are mapping each other's vulnerabilities. So while the public hears trade discussions, the private game is resource alignment. And that can escalate rapidly, because if one side feels excluded, it seeks alternative routes, new purchasers, new suppliers, new corridors. And in an already tense environment, supply corridors can become political flashpoints. So the 180 days isn't merely a timer on economics, it's a timer on relationships. Why silver and copper? Let's discuss why silver and copper attract singular attention, even listed alongside other minerals. Copper is the circulatory system of electrification. Every grid upgrade, every data center expansion, every electric vehicle rollout, every industrial modernization plan contains copper. Silver is the quiet workhorse of electronics and high-performance applications. Plus, it sits at the intersection of industrial use and monetary psychology. So when policy touches these two, you get both demand narrative types simultaneously. Industrial demand plus strategic demand. That's why volatility can spike. Timeline risk. I want to address the price minimum concept again, because people hear it and assume it's immediately constructive. It can be, but there's timeline risk. If markets believe the minimum is approaching later, they may sell now and purchase later, attempting timing the confirmation. If markets believe diplomacy will resolve it, they may fade the narrative and punish weak positions. If markets believe the minimum is approaching and will be aggressively enforced, they may anticipate hard and create a blow-off movement that later retraces. So the minimum creates optionality, not certainty. But optionality remains valuable because it changes what's possible. Processed materials. If you're still with me, here's the part demanding attention. This isn't merely about restricting imports, it's about rewriting regulations for processed materials. Processed. That word matters because it implies the bottleneck isn't the mine alone. It's the refining and conversion step. And if the U.S. wants reduced dependency, it will push investment into domestic processing, allied processing, and secure processing, which means capital expenditure, long-term contracts, guaranteed supply agreements. Again, the type of support capable of revaluing specific operators. If you're only observing spot pricing, you're missing the deeper current. Mindset for retention. Let me address mindset briefly, because retention is about maintaining focus. People love the drama of massive swings, but genuine wealth typically comes from understanding sequences. If you can identify a policy sequence forming, you don't need predicting the exact tick. You need positioning for the direction of the mechanism, and the mechanism is moving towards strategic industrial policy. Success stories. Quick friendly request. If you've succeeded in metals, trading, investing, business, anything, share your success in comments. Not to boast, but to give others hope and realistic models. Your narrative might be what keeps someone disciplined instead of emotional. What's next? So where does this proceed next? Near term, expect additional headlines about negotiations. Expect more sources indicate pieces. Expect commentators debating whether price minimums are beneficial or detrimental. Expect exporters lobbying. Expect importers panicking. Expect traders using every rumor as justification to swing pricing. And in the background, watch for stockpiling signs and procurement modifications, because those are the quiet confirmations. Infrastructure connection. Here's another key point. When the state starts discussing securing supply, it often follows with infrastructure spending. And infrastructure spending doesn't merely boost metals demand, it boosts demand for equipment, labor, energy, and financing. So if you witness a push rebuilding processing capacity, the secondary effects can appear in places people aren't monitoring. And those secondary effects can create surprise winners. Don't just watch silver and copper, watch the ecosystem, the human level. I want to bring the narrative back to the human level. Why should you care? Because when policy shifts, prices can gap, and gaps don't request your permission. If you're unprepared, you watch. If you're prepared, you act. So the takeaway isn't purchase everything. The takeaway is understand the map and possess a plan. Event recap. Let's recap the event in plain language. A national security investigation warned the U.S. is excessively dependent on foreign processed strategic minerals. The response was a proclamation ordering negotiations to adjust imports. The negotiation period is 180 days. The objective is pursuing minimum pricing with allies, price minimums. If negotiations fail, stronger trade actions can proceed, including minimum import pricing and national security restrictions. Silver and copper are explicitly caught in that framework. That's the narrative. And the reason I'm emphasizing this is because it signals willingness to intervene in market pricing for strategic materials. I'm going to conclude with a forward-looking question I want you answering in comments. If governments start establishing minimums, do you believe the next movement is higher pricing or tighter supply? Because truthfully, it can be both. And depending on how it unfolds, you'll want different strategies. So tell me what you think. And if you receive value from this breakdown, do the straightforward thing. Subscribe. Join the communication channel in the description for daily premium updates and voice messages. And check the exclusive content that should already be available for the comprehensive in-depth analysis.